Hello, this is your daily dose of financial market trends. The United States just identified more than 40 countries helping China dodge tariffs, and the fallout could reshape global supply chains. Plus, Nvidia's earnings clock is ticking as competition heats up. Heading into today's session, yesterday's close had the S&P 500 at 7,799, up 0.6%. The Nasdaq finished at 26,803, gaining 0.8, while the Dow added just 13 basis points to close at 53,840. The VIX pulled back slightly to 14.51, and the 10-year Treasury yield dropped to 4.64% as investors rotated into bonds. Let's dive into what's actually moving markets today. Nvidia is commanding serious attention across multiple channels right now, and for good reason. The chip giant reports earnings on August 26th, less than 2 weeks out, and analysts are already pointing to two competitors they think have more upside potential. Wall Street apparently wants those rivals 30% higher, which tells you expectations for Nvidia might already be priced to perfection. On top of that, there's fresh noise around China potentially evading tariffs through third countries, which could complicate Nvidia's supply chain and pricing power heading into that print. Applied Materials is catching fire on the opposite end of the spectrum. The chip-making equipment maker dropped 2.5% yesterday on volume nearly double its normal pace, and the social chatter around it absolutely exploded. When you see that combination of price weakness, volume surge, and conversation spike, it usually means something specific spooked either institutions or retail traders. Given Applied Materials sits upstream in the semiconductor food chain, any concern about chip demand or capital spending plans tends to hit them first and hardest. JD.com is having a rough day after reporting a rare revenue decline that sent shares down more than 7% yesterday on more than triple normal volume. Chinese e-commerce has been under pressure as consumer spending in China remains weak, and JD's stumble reinforces fears that the domestic recovery there just isn't gaining traction. For investors with exposure to Chinese equities or emerging markets broadly, this is another data point suggesting caution is warranted. Finally, JP Chase is showing up across geopolitical alerts and filings. The stock dipped about 0.5% yesterday, which isn't dramatic, but the context matters. Escalating U.S.-Iran tensions are pushing up risk premiums and borrowing costs, which could pinch net interest margins if Treasury volatility persists. Banks are also sensitive to geopolitical shocks that freeze credit markets. So watching how financials trade around Middle East headlines gives you a real-time read on institutional risk appetite. Let's zoom out to the bigger macro picture, because three major geopolitical scenarios are shaping risk right now. First, the US-Iran military confrontation is escalating, driving up borrowing costs and risk premiums across the board. The bull case, sitting at 35% probability, is that diplomatic channels succeed in de-escalating tensions through mediation. If that happens, Treasury yields would compress as safe haven demand fades, mortgage rates would drop, and equity risk appetite would return, especially in rate-sensitive sectors. The bear case at 25% sees direct military engagement intensifying with strikes on critical infrastructure. That would spike Treasury yields on inflation fears tied to energy disruption, push mortgage costs even higher, and trigger broad equity selling with a rotation into defensives. If the Strait of Hormuz becomes threatened, oil supply risk premiums would multiply fast. Second, U.S. authorities have identified over 40 countries allegedly helping Chinese manufacturers dodge Trump-era tariffs through transshipment schemes. The bull case at 40% assumes the U.S. pursues diplomatic solutions and narrowly targeted enforcement without broad tariff expansion. That would keep supply chain disruptions contained, inflation pressures modest, and current sourcing strategies intact for multinationals. The bear case is 30%, is that the U.S. imposes punitive tariffs on all those identified countries, creating a multi-front trade war. Global supply chains would fragment, forcing costly restructuring. Consumer goods inflation would accelerate from compounding tariffs, and corporate margins would compress. Emerging market currencies would weaken sharply as trade flows collapse. Third, the Trump administration launched targeted tariffs on Chinese drone technology. The bull case, at 45% probability, sees U.S. and allied manufacturers rapidly scaling production to fill the gap, benefiting defense and tech companies with reshored demand and reduced Chinese competition. The bear case, at 35%, is that domestic production can't meet demand near term, creating critical shortages in commercial and defense drone applications. Industries relying on drones for agriculture, logistics, and infrastructure would face operational disruptions and cost spikes, delaying capital expenditure plans and dampening growth forecasts. On the housing front, the 30-year mortgage rate sits at 6.69%, while inventory has climbed to 9.3 months of supply, well above the balanced market threshold. That oversupply dynamic is pressuring homebuilders, and if mortgage rates stay elevated, we could see margin compression and potential inventory write-downs as price competition intensifies. So what does all this mean for your portfolio? 5 things to keep front of mind. First, semiconductor equipment makers are flashing warning signs about demand, so watch how that upstream weakness flows through to the big chip names. Second, tariff expansion risk just got real with 40+ countries in the crosshairs, which means supply chain and margin pressure could surprise to the downside across consumer goods and tech. Third, geopolitical risk premiums are rising, especially around energy infrastructure, so consider how your portfolio holds up if oil volatility spikes. Fourth, housing inventory is building fast, while mortgage rates stay sticky, which puts homebuilders and real estate plays in a tougher spot near term. And fifth, Nvidia's earnings on August 26th are shaping up as a major catalyst, not just for the stock, but for sentiment around AI spending broadly. Position accordingly, but remember, this is educational content, not financial advice. Do your own research and consult a professional before making any investment decisions. That's your Morning Market Digest for Friday, August 14th. We'll be back Monday with another round of What's Moving Markets. Trade safe out there.